Ladies and gentlemen, dear members, good morning to you all. I'm Tanguy van der Werf, the DG of EFAMA. We are delighted to welcome you to this new EFAMA event entitled ELTIF 2.0, Get to Know the New Promising Regime. As you are most likely aware, the new ELTIF regulation was recently adopted by the co-legislators and published in the EU official journal, following a 2-year review and intense interactions with stakeholders, among which EFAMA, who has been very active on the file and whose views have been solicited by the policymakers on numerous occasions. This gives me the opportunity to thank all the EFAMA members who have contributed their expertise and who have allowed us to play such a key role in the ELTIF review. Kudos also to my colleague Elona Morina for her proactivity and leadership in this file. The goal of the ELTIF regulation, when it was introduced in 2015, was to help improve the financing of EU companies and projects that need long-term capital but do not have access to the public capital markets. However, and as we know, since its introduction, there has only been a modest number of ELTIF launches because of several restrictive features of the ELTIF regulation. The aim of the Commission's proposal was therefore to improve the functioning of the ELTIF and make the ELTIF a more attractive vehicle for both managers and investors, and as a result, increase the level of investment into the EU economy at a time when traditional sources of financing are becoming more challenging for businesses to access. As the title of our webinar suggests, the new regime promises to become a key enabling tool to mobilize capital for the financing of projects such as transport, sustainable energy generation or distribution, and new technologies. This morning, we will have the opportunity to discuss the most significant changes to the regime, including the new rules on eligible assets, portfolio composition and diversification, as well as the new provisions designed to encourage retail participation, to name just a few. To kick off the discussion, I'm now pleased to give the floor to Elona. Elona, over to you.
Very much, Tanguy, and good morning, everyone. My name is Elona Morina, and I'm the Regulatory Policy Advisor at EFAMA, and today I'll be your moderator. This morning, I'm joined by Stefan Staedter, our expert on ELTIF and partner in the investment management practice of Arendt. Stefan specializes in regulated and unregulated investment fund work and mainly advises clients on the structuring and life cycle management of alternative investment funds. He is also one of the firm's experts on the European long-term investment funds, and he advises the majority of ELTIFs established in Luxembourg. And we are very grateful to have him today with us. So, as you've heard, this morning we'll have the chance to get to know the redesigned and promising new ELTIF regime by discovering the additional flexibility that the new framework provides, and we will try also to anticipate how the ELTIF market might evolve in the next years. But before diving into the details of the provisions, maybe let's start from the basics. So, Stefan, can you please tell us what is an ELTIF and how this product contributes to the objectives of the CMU?
Good morning, Elona. Good morning, ladies and gentlemen. So an ELTIF is a pan-European regime for alternative investment funds, which is open for pan-European retail distribution. The ELTIF is so far the only label which allows actually a harmonized distribution across the EU on the basis of the EFAMA passport, and which grants access for retail investors. As you can see, and as you know, the CMU actually aims to allow for cross-border capital flows, and the ELTIF is one of the most important labels to accelerate and to implement this objective. A key component of the CMU is also actually the retail investor, and in this sense, the ELTIF contributes to the democratization of private assets because it grants to the retail investor access to assets where normally only sophisticated investors had access to. The ELTIF aims to get access to alternative sources of finance, which is even more important in situations as we have it now, where we have tensions in the banking sector, where we have a risk of inflation, and where we have volatile market conditions. And as the ELTIF is focused on long-term investments and long-term assets, it guarantees a steady income over a longer period.
Thank you, Stefan. So you mentioned already quite a few features and characteristics of ELTIFs. During the review process, the industry has been asking for further flexibility in the regime and the removal of what we would call unnecessary barriers that have undermined the product attractiveness. So do you believe that we achieved those results, and what does the revised product look like today?
So looking to the result, in the form of the published text on the 20th of March, I think there's no doubt that the ELTIF 2.0 has definitely increased its attractiveness. If we compare the previous regime, and the previous regimes you see in the top line in blue, with the new regime, which is actually the yellow one at the bottom, you can see that the ELTIF as such is still hybrid in nature, means it's a mixture of an alternative investment fund with a UCITS, because it combines some features such as the diversification, which is typically a UCITS feature, the fact to appoint an AFAM, which is typically an IF feature, and also the fact that you need to appoint a depositary, which is also able, such as a credit institution, to handle retail investors. Safeguards. In this respect, it comes again from the UCITS side. The ELTIF is still a regulated product and also needs to be managed by a regulated manager. But what is new? We have clearly identified a certain simplification and flexibilization when it comes to the asset classes, when it comes to the investment side, when it comes to a couple of features. And in this respect, you can see, and on the right side of the slide, you see a couple of examples, but maybe give you a little bit I would like to highlight a few of them, and notably the flexibility regarding portfolio composition because you have to know that an ELTIF is composed or may invest in two types of asset classes, and goes in the direction of a liquid. And this is typically where you can operate on all UCITS type of investment. And this got increased from previously 30% to 45%. So an ELTIF in a nutshell is more liquid now, can be more liquid now. On the other hand, this means effectively a decrease of the long-term investment sleeve, which must be now a minimum of 55%. There is also more flexibility when it comes to the diversification criteria. So before we had a diversification of 10 for the illiquid investment, 10%, and 5% when it comes to the liquid investments. We have now 20 as a new 10% and 10 as a new 5%, which grants the asset managers more flexibility when designing the portfolio. And we can say that we have broadened significantly the scope of eligible assets. And in this respect, just to say, an ELTIF on the illiquid side would invest in private equity, debt, and loans, but now, and also in real estate and real assets. But on the real asset side, we can identify that that the minimum investment of 10 million has been removed. And also the definition of real asset got simplified, which makes it much easier to operate an ELTIF whenever it's contemplated to follow a real asset strategy. Maybe one word on the additional asset classes which have been added on the illiquid side. We have the STS, so the securitization, and we have also the green bonds, provided that the two of them have a long-term feature, because as the name says, it's contemplated to follow on with the illiquid portfolio a long-term strategy. If you see on the slide, you see also one word which is linked to qualifying portfolio undertaking. And in this respect, we can say that actually nowadays, and with ELTIF 2.0, we will have only to satisfy 3 criteria, which are a little bit more flexible than they have been before. On the right side, you will see the new text. So a qualified portfolio undertaking is actually anything which is non-financial undertaking. And in this respect, there is now also the exemption for so-called fintech exemption, which allows to invest nevertheless in financial undertakings, provided they are authorized for no more than 5 years in the past. And we have also some more flexibility whenever it comes to investments in listed companies, because normally, by definition, the illiquid portfolio was more contemplated to invest in unlisted companies. To a certain extent, you could invest in smaller listed companies, and now the market capitalization threshold got increased to 1.5 billion, which is quite a success because the scope of eligible companies got significantly broadened. And the good news is also on the third country investment side. We have much more flexibility because the previous Article 26 OECD Model Tax Convention compliance test, which needed to be operated by the companies, by the asset managers whenever they invested in third countries, has now been replaced by a simple analysis whether the jurisdiction you are contemplating to invest in is a non-cooperative jurisdiction from a tax point of view, which makes the life and the monitoring much easier. One final word on the geographical scope. In a quite prominently place in the regulation, you will see that in Article 1, the word European Union got deleted, which means that there is now a clarification for asset managers ultimately that they can make investments also outside of the EU, and that there is no minimum threshold for making any investments in the EU.
Thank you, Stefan. Quite a few changes indeed. And maybe just to recap, what we hear is that the revised regime is definitely more flexible and it has been simplified, mentioning the increased liquidity pocket, more flexibility when it comes to diversification requirements, and definitely a broader scope of the eligible assets, which from our perspective will increase the product attractiveness. Maybe one last question concerning the fund rules. So during the last year's discussion, some attention was also dedicated to the benefits of ELTIFs, including fund of fund and master feeder fund structure, and also the increased leverage thresholds. Can you please help us maybe understand what that means, and what are the benefits for the revised ELTIF?
Yes, if I may, I just show this small picture structure chart, and in order to demonstrate a little bit the fund of fund structures. So if we have a look to this slide, we will see that an ELTIF may invest, and you see the ELTIF EU, Luxembourg, ELTIF could be also any other EU country, which will invest through a holding type of company, and then which may be there in order to aggregate some investment. And then you actually have further down the chain, you have the EU EFAMA. So based on the rules of the new ELTIF regime, it will be possible that actually an ELTIF invest as a target in EU EFAs, which itself will need to be managed by EU EFAMs. And these must invest in eligible investment assets. So this means they must invest itself private equity, debt instruments, loans, and real assets, and they should not have an exposure of more than 10% to any other type of undertakings for collective investments, because the aim was actually to stay as close as possible to the real economy, and so that the purpose shouldn't be to create ELTIFs investing in fund of fund of fund. just and if it's the case, just for a limited type of number, so not more than 10%. Why is this fund of fund needed? Well, one argument is actually it gives you structuring flexibility to the asset managers, because as you can see, if you look to the slide, you see you can have an intermediary company, and further down you have an alternative investment fund. And actually, it could be also that this intermediary, if you can, so for a certain reason, needs to qualify as an alternative investment fund, because in some countries you can only operate if you have, for instance, an alternative investment fund status. And on the other hand, if you are investing, if you allow for investments in the EU alternatives, it facilitates also the deployment of capital, because in some situations you need, if you want to grant the diversification of, as I've indicated, 20%, then you need at least five assets, and this is much easier to achieve if you have already an existing portfolio. And when you have an existing portfolio, then it's in some cases very likely that the holding company of this will have an alternative investment feature, a fund feature. And so it's also very convenient to have actually in the future the possibility to invest in EU alternatives. And another point, it strengthens in the sense also the diversification for the retail investors. And because if you imagine that you invest with an ELTIF in 4, 5, 6 underlying funds, and on the side you invest in directly, from this point of view, you will have a certain diversification risk, which will be actually limited in this respect.
Thank you.
Sorry.
No worries.
So if you, on the leverage, because this was also one of your questions, on the leverage, we can say that the borrowing rules have been actually simplified. And in this respect, it's actually very helpful, notably when it comes to real asset managers who need it, especially when you follow a certain development strategy. You have a higher exposure than the initially 30% of the relevant capital. You needed a higher degree of exposure of credit lines in order to pursue your strategy, and that's why everyone is very happy to got now the 50% of the NAV as a maximum whenever it comes to borrowing in the context of retail ELTIFs. Whenever you contemplate to set up an ELTIF which is for professional only, then you could go up to 100% of the NAV. Maybe one point on the borrowing. The borrowing is now also much more flexible in the sense that short-term borrowings are out of scope of the calculation for the borrowing purposes, provided that actually, and this is very similar to the rules which exist under level 2 of the AFMD, that everything is covered by the undrawn commitments. And another point on the borrowing is actually there will be now also a ramp-up period introduced, which is quite convenient because notably at the beginning they may have a higher exposure because the NAV may be lower. It's just from an operational point of view, because notably when you haven't performed any drawdowns and nothing has been invested so far. So, and you intend to build up your portfolio.
Thank you very much, Stefan. Sorry for interrupting you earlier. I just saw a couple of questions already coming in from the audience, and I thought it would be good if we can try to address them. So one of them, for example, asks if ELTIF can be compared to ELTAF in the UK. And also if you have on top of your head, what would be the total asset under management reached by the ELTIF market?
Yes, I was very recently listening to a presentation about ELTIF, and I know that so far there is one which has been launched in the UK, and I think another one is potentially in the making. My understanding was, at least from the presentation, and I'm not a UK lawyer, but my understanding was that it's very complex. The rules of an ELTIF and especially when it comes to the diversification, when it comes to the portfolio composition. So I think in a way the name is very similar, but I have to say that it's European scene, from what I see from ELTIF 2.0, the ELTIF looks much more simple and much more flexible than what I've seen on the ELTIF rules.
I see different questions coming, so maybe I will quickly kind of raise other two questions that have been raised. One of them, for example, asks if third country investors can now invest in the new ELTIF 2.0 framework, if that is correct. And the second question asks, are multi-layer ELTIFs fund strategies allowed, or the limit of 10% for bids such strategies?
So the first question, if I got you correctly, is if it's third country investments, not investors. So to make investments in third country, yes, it's allowed to make investments, but it was always allowed to make investments in third countries because Article 11 was allowing for it. It offered the possibility to make this investment. What we have now is more a clarification, because there was a little bit reluctance on allowing in the majority to go for third country investments, because there was a recital 4 which seemed to have a preference for making investments in Europe, a little bit comparable to what we have in the US BDC. So from this point of view, this has been clarified now, and it looks for me that there's an equal treatment for investments in and outside of the EU, save of course for the safeguards which have been put in place for third country investments, meaning no issue from an AML point of view, so no blacklisted country, and also no blacklisted country from a tax point of view. And the second question, could you just kindly repeat the second question?
Of course. So the question asks, are multi-layer ELTIFs fund strategies allowed, or the limit of 10% for bids such strategies?
So multi-layer ELTIFs, so one layer is possible so that the ELTIF can invest in another EU alternative. But you have, of course, a diversification and a concentration rule to be respected. The diversification rule is actually 20%, so you need, at least from the investing ELTIF point of view, you need to make sure that you're not that you have at least 5 investments, and from a concentration ratio, you should make sure that the target you invest in, that you don't have an exposure in this target of more than 30%. And now the question is, if this fund where you invest in is invested in another fund, then you should make sure that the target fund should not have an exposure of more than 10% to other funds on an aggregate basis. If you are going beyond the 20% of the diversification, it could be considered that the ELTIF will actually come as a master feeder structure. But in this case, if you see it on the right side of the slide, if you want to have a master feeder, you must make sure that you have actually both labeled as an ELTIF, the master and the feeder, or that just the master is an ELTIF, but an ELTIF as such cannot invest in a non-ELTIF master.
Thank you very much for clarifying that. Maybe just going back to the changes of the revised regime, the review process have addressed the strict fund rules, but another major objective was the so-called retailization of the product. So as we mentioned at the beginning, ELTIFs were born as a kind of hybrid solution between an alternative investment funds, but it is combined with some retail vocations. So ELTIFs are marketed to retail investors. So one of the issues raised during the review process were the numerous impediments and barriers for retail investors' access to ELTIF. So do you believe that now we have a product with rules that do encourage retail participation?
So similar to the asset side, I think also on the distribution side, there are quite a lot of achievements which are coming with ELTIF 2.0, and they make it actually more simple and less burdensome, as a couple of asset managers and distributors have seen it in the past. Because, for instance, we got rid of the minimum investment ticket. Before, there was like a minimum investment ticket of, if you see it always, the status before on the left and the status now, which we're happy to have is actually on the right, it was like 10K. To the extent that you have a financial portfolio of less than 500K, which means that there was a different treatment between investors having less or more than 500K, which made it very complex for the distributors to follow, because they had to put in place a special type of regime whenever you had an investor between 100K and 499K. Then you needed to make sure that this investor invested at least 10K, and that this investor did not invest more than 10% on an aggregate basis in all other ELTIFs, which was okay for the first investment, but which was much more difficult to monitor for the second and third type of investments. And the question which I regularly got was, how often shall I check? Do I have to call each month my investor to check whether he's above the 10%? And so now this has been removed, this 10%, and which means that theoretically, if you pass the suitability test, you can take a significant part of your portfolio to be invested in an ELTIF. And we have no further distinction actually between the smaller retail and the bigger retail, which actually is, from my point of view, together with the educated recognition of the investor, because an investor now can override actually also a negative method suitability test, means that you get a strong angle on the democratization of assets, because the investors, they will actually be able to have a word to say in terms of savings on a long-term basis. And it's not anymore a sort of a privilege for more sophisticated investors.
So when it comes to ELTIF, that means that on one hand, we are talking about a type of fund where the money has to be invested and committed for a long term, while on the other hand, we would like to see more participation from retail investors who, however, are used to frequent redemption terms. So what kind of solution does the ELTIF 2.0 offer on that?
Well, on the district or on the liquid asset side, or to put it this way, on the liquidity terms, and the exit possibilities, the ELTIF as such is now much more flexible, because as you have indicated, a retail investor is by nature looking for liquidity and certain exits in case personal circumstances changes. So from this point of view, the new ELTIF regime takes this need further into consideration and puts in place also some safeguards for this type of early exits. And we have here, we have on the one hand the possibility to exit by means of a redemption. And on the other hand, we have the option to exit by means of a matching. Maybe starting with the redemption. On the redemption side, and just to say this, it was always possible to derogate from the rule that redemptions are not allowed during the life of an ELTIF, because Article 18.2 was actually existing since the beginning. However, just a few asset managers on the market made use of it because there was a certain uncertainty about how this rule will apply and how this needs to be tailored. So from this point of view, it is nowadays clear that actually it's that there are no redemptions possible during the ramp-up period, or, and this is a new item which came in as an alternative, or you set out a certain lockup period during which you can't perform redemptions. So, which means that it is not something in ELTIF shouldn't be immediately liquid. There's always a sort of a locking type of moment for the investor, which has to do obviously with the idea to build up a portfolio and to keep the capital as stable as possible. You need to put in place a redemption policy, which clearly lays out, and this is something which is mostly to be addressed to the AFAM, to the asset manager. Of course, taking into consideration the features of the relevant fund. You need to make sure that there is a fair treatment. And another point which makes redemption in the ELTIF context a little bit specific is actually you can only serve yourself with respect to the redemptions out of the liquid portfolio. So the goal is not to sell your long-term assets when you are facing exit requests. You have to make sure that you have always sufficient liquidity to meet potential redemptions requests on a forecast basis. Of course, you can operate this you can combine it with a common liquidity management tools such as granting, for instance, credit lines, allowing for gatings in certain situations, in extraordinary situations. But you have really to put in place a forecast mechanism in order to have sufficient liquidity in place in the liquid portfolio in order to allow for the redemptions to be performed. Of course, we can also work with notice periods. So there are plenty of features which will ultimately support this idea, but there are ways out. There is a way out by means of a redemption, and if a redemption doesn't work, then potentially, and this is a little bit the twin for the exit, is actually the matching, which is like a secondary mechanism where we count actually on that one investor is transferring to the other investor. And this may be organized by the fund or by the manager or by the distributor, where we actually will have a scenario that one wants to exit and another one would like to subscribe, and you can actually couple them. Provided that you have also a policy in place, that you will have also a clear, a fair treatment, and that you perform the MiFID suitability test. Because this applies also in the context of the secondary market, and I think there we see clearly that investor protection is something which has been taken into account strongly by the ELTIF 2.0, together with the diversification rules, the cooling off period, and also together with the fact that we have here a regulated product which is dealt or which is managed by a regulated manager.
Thank you very much, Stefan, for clarifying that. I have a question from the audience on the liquidity part, which I believe you have already explained, but maybe you can clarify some doubts. So the question asks, you mentioned that the ELTIF 2.0 can be more liquid due to the maximum 45% of other assets eligible for UCITS. But can the ELTIF provide monthly liquidity or quarterly liquidity?
There is no guidance in the level 1. It depends on what you can perform on in your product. So actually, you need to make a check that you have the liquidity on a monthly basis, on a quarterly basis in your liquid portfolio in order to satisfy this type of redemption request. But this will be ultimately to be assessed on the individual portfolio composition and the investment strategy together with the AFAM. And of course, whatever other tools you will have in place, meaning, as I said, longer notice periods, settlement periods, gates, credit lines, etc. So that but this will be a very individual analysis to be done, and so it's more to be discussed on a case-by-case basis.
Thank you. More on based on your opinion, you know, we saw that there were many changes related to the removal of the obstacles for the retail investor participation. I was wondering if you believe that the updated rules will kind of achieve the goal of boosting retail involvement in the near future.
I think based on my experience, there are actually several products on the market which we can group in three. So you have actually the professional only ELTIFs, which were already existing, which are already existing, and which are now a little bit, which are quite interesting for some of the players. Then we have, on the other hand, the almost professional ELTIFs, which are currently distributed through the segment of private banks. And then we have the retail ELTIFs. And I think my expectation, but it's also a lot of hope in it, is that the new rules will actually boost notably the third group, meaning the retail ELTIFs. And because distributors will potentially be less afraid than before, because the previous barriers of distribution got removed. And I think that also, to a large extent, retail investors have now a better perception of ELTIFs. I mean, I think also this helps that we are speaking today, but I think the ELTIFs are more and more in the media. And from this point of view, I think if I speak with initially when I was working on ELTIFs, nobody knew what an ELTIF is. Now family members and other colleagues are asking me and knowing what an ELTIF is, which I think is quite a success, and that it's actually it evidences that there is a certain mass affluent interest in ELTIFs, which could stimulate the trend of getting more retailization out of the ELTIF.
So we can definitely conclude that probably the new regime is more conducive to retail participation compared to the previous one. Well, now that we have clear ideas on how the redesigned framework looks like, maybe we can have a look at what's to come and what to expect in the coming months and years. First of all, regarding level 2, so as we all know, by January 2024, ESMA is required to submit some regulatory technical standards to the Commission on both the redemption terms as well as on the use of the matching mechanism. So in that regard, what do you think the level 2 should look like, and what are maybe the key aspects that ESMA should take into consideration when drafting them?
So I hope really that level 2 will follow the good intentions and the stimulating spirit of level 1, and that the achievements will not be locked ultimately through the back door. Asset managers require stability and flexibility in order to design their products. And for this reason, they should have flexibility when defining the proportion of needed for the redemptions, because there's one of the rules in Article 18 which will grant ESMA actually the power to define the criteria. And I think what we need to take into consideration for this type of criteria is also that we leave the asset managers sufficient margin to adapt this to its existing strategies, because nobody comes out with an ELTIF dedicated strategy. Most asset managers, what we have seen on the market, they are plugging in the ELTIF to an existing strategy. So I think we should not expect that the manager will necessarily adapt to the ELTIF, no, the ELTIF. And I think with level 1, there is a big achievement, has adapted to the needs of the asset management industry, and ultimately then also to the distributors and also to the investor side, which is one of the key hopes I have, that actually this level of flexibility will be kept. And I think also, on the other hand, when it comes to defining some of the criteria in the matching policy, that we keep in mind that there is so far not really a secondary market existing. So from this point of view, I think what we should do all in order to allow to stimulate the secondary market which will ultimately end up in a way that I will be happy to take over the ELTIF shares Elona has in some of the ELTIF products, and that we can organize it through a very simplified measure, and that matching is actually to be considered as one of the tools for managing liquidity, because ultimately it has no impact neither on the capital nor on the NAV. And from this point of view, it is a better way than actually having a redemption. So maybe one of the first option rather than the second, because it doesn't trigger any sort of variations in the capital of an LP.
Thank you. Maybe one last question from my side before checking the questions from the audience, given that I see quite a few coming in. So what I hear is that many barriers that have prevented ELTIF from being attractive have been removed. And on the other hand, now it's up to ESMA to define some of the functionings of redemption terms and matching mechanism. But from your experience, is there anything that, for example, member states can do to encourage the take-up of the product in their own jurisdiction?
I think one of the key elements, and there we have also some scientific proof, is when you look from a tax incentive point of view. Unfortunately, there is no tax regime specifically dedicated for ELTIFs, which is applied across the EU, but I fully understand it's not the mandate for the time being. However, we see that some countries as Italy, they were quite successful in putting in place the peer regime and to activate it also in the ELTIF context, which explains a significant number of ELTIFs which have been set up in Italy and which are distributed in Italy. And there also we can say there's a testimonial in Italy where we could actually say, well, in Italy the ELTIF is perceived as a quality label, which shall be bought by the retail investors, and which has a certain attractiveness because you can, as a retail investor, make some deduction to the extent that you keep a certain threshold, that you don't go beyond a certain threshold of investments, and that there is an Italian nexus when it comes to the investments. Another point is potentially to stimulate the ELTIF industry and ultimately also to bring more ELTIFs and more competition on the market, is actually the fact that in Spain, for instance, we have seen earlier this year that a new bill of law got adopted, where actually the managers will be allowed to make some deductions whenever they manage an ELTIF. And this is also something which can have an impact whenever you plan to do an ELTIF or a non-ELTIF. It can give you a little bit help of taking your decisions. Another point is not tax-driven but regulatory-driven, is that in some countries, and for the Solvency II regime, so we're speaking about insurance companies here, for instance, there are some possibilities to qualify an ELTIF actually as an equity trade, and from this type of point of view, you need to have less own funds whenever you make an ELTIF investment. And I think this could be also one of the venues. Unfortunately, according to my understanding, it is not harmonized in every country, this point of view. That's why you need to make a country-by-country assessment for the Solvency II regime in this respect. And that's why you have to reach for the individual member state. But I think the member states could potentially work on this and to facilitate. And a good example here is France, for instance. They have apparently have this option in place.
Thank you very much, Stefan. I know that we already ran out of time, but I believe there are two very interesting questions raised by the audience that is worth addressing. One of them concerns the possibility to allow redemptions before the end of the life of an ELTIF. And here what they ask is, in your view, how can this be achieved without draining the liquidity portion of the assets over time?
I think this is a very interesting question, which where we come to the area of economics. I have to say, I have seen some products in the past which were quite successful, but of course, putting in liquid assets means, of course, less returns. So I think there is no, but it means also, on the other hand, to bring in more capital from the retail. I think there is a little bit of a, so if you could go bigger in size, then you would actually be without bringing in this flexibility. I think there is a sort of an analysis to be done, but it's more an economic analysis, but it could be also quite interesting because we have some players who have played successfully this part, and they gained a reputation, and so this could be something which is more than just return.
Thank you. And another question concerns maybe a clarification on the timeline. So one of the audience asked, does the new ELTIF also need to wait for the 9 months period, or could we launch ELTIFs 2.0 in 2023?
I have to say, I mean, I'm quite open in reading the provisions of Article 38, and my hope is, I mean, if you look to the text, you actually will see that the derogation which speaks about notwithstanding the third subparagraph may choose to be subject to this regulation provided that the competent authority is notified thereof. Third paragraph deals actually, if you look to it, seems to deal mostly with existing ELTIFs, but it says also ELTIFs authorized in accordance with applicable before 10th of January, which means for me, technically speaking, that you could say that everything what is set up now could also go for ELTIF 2.0.
Thank you very much for your interpretation on that specific provision. I know that it has been up to discussions during the past months for sure. So I am conscious of time, and maybe with that I would like to conclude this event. Just a few conclusive remarks from my side. So what we've heard today is that the review of the ELTIF regime managed actually to lay down the foundations for an attractive, a competitive product that hopefully will be able to facilitate a promising ELTIF market ahead of us. And with that, I would like to thank very much Stefan Staedter for its participation, and all of you for joining and taking the time to be here today. I see that there are still many questions to be asked, so please feel free to reach out to us and we will be happy to provide you with some answers. But for the moment, thank you again, and I hope to see you very soon.
Bye-bye. Thank you. Bye.